So, good afternoon, everybody. So, today's session will talk about, or in the session for today, we'll try to discuss about a few of the beta strategies, right? We usually talk about smart beta funds, right? So, in the previous sessions, we've tried to understand that what exactly is an index fund, what are ETFs, exchange traded funds, right? What is the difference between an index fund, a mutual fund, and an exchange traded fund ETF? Right? So if still you guys haven't watched those videos, just go via the modules of the live lectures recordings. Okay. So all these things have been clearly taught to you in the previous sessions. But this session will talk about something different. Still, do not worry. If you haven't watched the previous sessions upon index funds, upon passives, upon mutual funds, upon ETFs, you still can understand this session. But after this session, just take out some extra effort to watch those sessions upon mutual funds, passive investing, active investing, right? ETF especially, because exchange traded fund is the most popular vehicle, right, towards investment in the current environment. Agreed, it's much more popular in the global markets, especially the US markets and European markets. But again, ETFs is also emerging as a great investment vehicle in India also. Many of the fund houses, many of the asset management companies have started to launch their own exchange traded funds, ETFs. Right? So that is one thing. So this strategy or the smart beta funds or the smart beta strategy we're going to talk about in today's session. So I'll just start sharing my screen as well with you without wasting any time. And again, we usually talk about four beta strategies or four smart beta strategies. And we'll try to relate those strategies with the current market environment. Okay. So here we are, and here is the whiteboard. Correct. Done. So see, usually if we talk about the different styles of investing, we talk about the active style of investing and the passive style of investing, right? And we all know that what is the difference between the active style of investing and the passive style of investing, right? In the passive style of investing, we're trying to replicate the index. In the passive style of investing, we are trying to replicate the index. So for example, if we have a passive mutual fund or a passive ETF, because basically what happens, majority of the ETFs which you find in the market are passive ETFs. Nowadays, active ETFs and smart beta ETFs have also started to come into place. But majorly when the ETF market started to get a boom globally, we just used to have passive ETFs. But nowadays, we also have active ETFs and smart beta ETFs, right? Again, we can also have smart beta mutual funds also. We talk about the smart beta strategy, not to worry. But if you talk about a passive investing strategy, if anyone asks you the styles of investing, you always have two styles of investing. One is the passive style of investing, and the another one is the active style of investing. So in the passive style of investing, we are trying to replicate the index. There are various ETFs, there are various mutual funds who just try to replicate the index. It can be a Sensex 30, it can be a Nifty 50, it can be small cap indices, right? The Nifty small cap 250 index, it can be a Nifty 150 mid cap index, right? In US, we have the NASDAQ, we have the S&P, we have the Dow Jones. In Europe, we have DAX. In the British markets, we have a CAC, we have the FTSE, right? In the France market, we have the CAC, right? In the Chinese market, we have the Shanghai's. In Japanese, we have the Tokyo Stock Exchange. So whatever fund is trying to replicate the index of their own markets, an Indian fund will replicate an Indian market index, be it Sensex or Nifty. A Japanese mutual fund, a Japanese passive mutual fund, or a passive ETF will try to replicate the Tokyo Stock Exchange. So whatever return the index is giving you, they try to mirror the same return into your passive strategy or a passive mutual fund or a passive ETF. But the exact return they might not be able to give you. So for example, if we talk about India and we have a Nifty index fund, a Nifty 50 index fund, there will always be some expense ratio. There will always be some expense ratio. Though the extent of the expense ratio or the quantum of the expense ratio in a passive fund will be far less as compared to an active fund. But there will always be an expense ratio, be it 0.01%, 0.02%. But some expense ratio will always be there. And that is the reason why the difference is there in the Nifty 50 index, as we see in the market, and the Nifty 50 index fund, which we have invested into. Though the returns would be very similar to one another, but a few basis points might be here and there. So passive fund might be giving you a few basis point lesser returns as compared to an index fund, as compared to a simple index in the market, be it Nifty, be it Sensex. And the major reason is expense ratio. So agreed, the fund manager in a passive strategy, he doesn't have to make any kind of active selection because he's just trying to mirror the index in terms of returns, in terms of weights of stocks, right? So whatever weightage a particular stock has in a specific index, the fund manager is trying to replicate or just exactly mirroring or replicating the exact weightage of that stock. So for example, hypothetically, if the weight of a company A is 20% in Nifty 50 and the weight of a company B is 15% in the Nifty 50, the fund manager will try to replicate the same 20% weight of company A and 15% weight of company B in his own passive index fund or the ETF strategy. And he's just following the index. He's just trying to replicate the index or mirror the index. He isn't doing any kind of active fund selection, active stock selection. So security selection ka principle is not here. The asset allocation ka principle is not here because we aren't talking about multi-asset investing. We're just talking about pure equity investing. We have chosen the asset class equity, but there is no active stock selection. So on a quarterly basis, sometimes on a monthly basis, yearly basis, the Nifty tends to rejig. And what do I mean by rejig? Some stocks tend to get out of Nifty 50 and they get replaced by new stocks. So once it is done in a Nifty 50 or a Sensex 30, the same is done by the fund manager also. So exactly same replication, be it in terms of rejig, active selling of stocks, if the index is selling off those stocks, active buying of those specific stocks in exactly same weightages, in which the index is buying those stocks in case of rejig or an index rebalancing, right? As we popularly talk about portfolios rebalancing, that's the buying and selling of stocks in the portfolio, right? The portfolio rebalancing or the portfolio turnover, which is basically nothing but the buying and selling of stocks in the portfolio, depending upon the strategical market conditions, tactical market conditions. The fund manager is trying to take some strategic bets, some tactical bets. Right? Similarly, if this kind of a reject or a turnover is being done in an index fund, be it Nifty, be it Sensex, Nifty small cap, Nifty mid cap, the same is being done by a portfolio manager in a passive index fund. So ideally, he shouldn't be called as a portfolio manager in case of a passive fund because he's just trying to replicate the index. But if you talk about an active fund, an active style of investing, he wants to beat the index. So for example, right, if a Nifty 50 is giving you a 12% return, if we talk about a 10-year CAGR of Nifty 50 is between 12 to 13%, 12.5%, right? So basically, assumingly for the sake of simplicity of the calculation, if a Nifty 50 index is giving you 13% return, an active fund manager wants to beat that 13%. If he beats that 13%, beat by 1%, even he's an active fund manager. Whereas a passive fund manager wants to have that 13%. He's not interested to have that 14%, 15%, 13.1% even because he's just trying to copy or mirror the index or replicate the index. But the exact returns in a passive fund won't be 13%. It might be 12.95, 12.97, 12.92 on account of the expense ratio, which all AMCs charge upon their passive funds or active funds. But an active mutual fund manager or an active portfolio manager wants to beat that 13%. So for example, if Nifty 50 give you 13% and fund manager give you 20%. So 20%, ठीक है, ये देखो. If Nifty 50 gave you 13% and your fund manager or the portfolio manager gave you 20%, right? So 20 minus 13 is equal to 7. So 7% is your alpha. It is your exit return on account of his fund management abilities because the portfolio manager has spent time to understand the markets, to understand the index, to understanding your own portfolio, and he has undertaken active stock selection, right? The principle of asset allocation is done because he has chosen equities. So now he works towards the security selection, right? So security selection is something which is helping him to give the extra return to the portfolio of 7%. So 13% be the index ka return, 20% is the portfolio's return. And the difference between the 20% and 13%, your 7%, right? It is your alpha or the exit return which the exit fund manager has given you. He wants to beat the index. His main aim is to beat the index. So nowadays we have seen as per the recent studies that more than 70%, 70 to 80% of the fund managers aren't able to beat the index. They underperform the index, right? But those who are able to beat the index, right, are those fund managers who have the adequate skills, have the adequate expertise to understand the markets, to understand stocks, and have an active stock selection strategy to beat the benchmark. The benchmark or the index is giving you just 13%, and it was able to give you 20%. Why is active stock selection abilities? Now, some people might question that 7% was on account of asset allocation or security selection. So we have talked about the Brinson's model. The Brinson model is available as modules, deep dive. It's also available as an overview session via my YouTube videos, right? So we have tried to break down the alpha via the asset allocation, security selection, and interaction effect. The popular Brinson's model has been taught in the CFA also. If you haven't watched those videos, just go back to my YouTube channel, go to my modules on the website, go to my live recordings, you will understand deep dive Brinson's model, right? So in the Brinson's model is tried to break down the alpha or the exit return, that is the 7% may kitna is coming out of the asset allocation, how much is attributable towards security selection, and how much is attributable towards interaction effect. We are trying to break down the 7%, right? So out of his stock selection abilities, he's able to give extra alpha or the extra total return to client, right? And the 7%, though some portion will be attributed towards asset allocation also. Some portion will be attributed towards the interaction effect also. But the major proportion will be attributed towards the selection effect because it chose the asset class equity, because the fund manager hypothetically is managing an all equity fund portfolio and all equity mutual fund. He chose that. But to get that extra 7% alpha, that extra 7% return, he's going via the active stock selection, the security selection principle of the Brinson's model, a very important concept in CFA, a very important concept which people practically do in top investment banks to break down the alpha. And top mutual fund companies, not even top, every mutual fund company, every asset management company, every investment bank is breaking down that alpha via the asset allocation, security selection, and interaction effect. And again, that is very important. We have one question. It says that does active also means finding high growth equity stocks and invest in that? Not only high growth, they can focus towards value. They can focus towards momentum. Like we'll talk about the smart beta. So whatever the fund manager is doing, he might be going towards a growth strategy. He might be going via a value strategy. He might be going via a momentum strategy. He might be going via low volatility strategy. So whatever strategy he want to implement with the stock selection, but that should give extra alpha. That should beat the market. If he's using any of the strategies in the market, be it value, be it growth, be it volatility, be it momentum, be it quality, be it equal weighted, and it's not even to beat the benchmark, right? You cannot call him as an active fund manager. So by the namesake, he might be an active fund manager, but he hasn't able to even beat the index. Some fund managers aren't able to give a similar kind of a return as an index also, right? Because the stock selection abilities might not be so good, or they might not be able to track the markets because the global financial environment has become too complex and complicated to understand. So there's 15 to 20% of the portfolio managers or 15 to 20% of the fund managers beat the index. They can follow any strategy, be it high growth stocks, be it value, be it low vol, be it high momentum, be it equal weighted, but they just have to beat that index, right? So that is the major difference between an active style of investing and a passive style of investing. Further, if we talk about smart beta strategies, again, those are very crucial. And all these strategies might not work always. There are different market cycles, there are different market environments in which these smart beta strategies will work. Because this smart beta strategy is comprised of multiple components that we'll discuss here very briefly. So usually we call them smart beta strategies, or we also call them factor strategies. You might have heard about smart beta investing, factor investing, right? So it means just the same. Smart beta mutual funds, smart beta ETFs. So majorly you shall find these strategies into ETFs. Lesser for mutual funds, but more for ETFs, right? So this passive strategy of investing with a twist in between, right? So again, the smart beta strategies and the factor strategies have the base of passive only, right? The passive ETFs or simply the ETFs. But when you try to work and twist the way they tend to operate, right? We try to modify the way they tend to operate. We tend to call them as a smart beta strategy or a factor strategy. Smart beta investment strategies or a factor-based investment strategies very popularly being used nowadays. And people have been using these strategies, trying to understand these strategies globally, especially after the COVID-19 pandemic. Because after the COVID-19 pandemic, the global financial space has changed completely. What used to happen in the market, right, historically before the COVID-19 pandemic, right, those things have started to reverse. Be it, for example, the negative correlation between the fixed income and equities, be it the long-term correction of the market, because usually what used to happen before the COVID-19 pandemic, if the market started to correct, it used to correct for years and years and years. But nowadays, we have seen that even if the market starts to correct, it corrects for 15 days, 20 days, 5 months, 6 months, max to max. After that, again, the market rises, it goes towards consolidation, and then the market starts to rise again. So those drawdown modes, those downturns are not very, I would say, elongated as of now. Be it the 2000 crisis, the 99 dot-com bubble, right? All these downturns were elongated for years and years and years. But where the COVID-19 pandemic, all these downturns, they also started to, I would say, started to shrink. The length of these downturns or downward cycles are not so long now, right? The market goes down, the market faces the correction, but still the DIIs, they still tend to invest. Their SIPs continue, right? The positivity in the market is still very high because India has the next 15 years and 20 years down the line to achieve a 10 trillion mark, 20 trillion mark economy in terms of GDP, right? So all these kinds of factors, all these kinds of things have started to come up. Positive sentiments, positive news, a supportive government, your government expenditure, right? The consumption activities have also started to rebound by the both urban and rural segment. So there are various things and various reasons why the markets have started to rebound and why all those corrections are now considered as healthy corrections and they do not pertain in the market for long term, right? But understanding these smart beta strategies or factor beta strategies is something which is very important. The very first strategy, if I talk about, right, usually what happens, we talk about four factors or four betas. One is growth. Number two is value. Or basically, instead of growth, like we'll try to discuss that in a different context. Let's name it as quality. Ignore the growth as of now, okay? Quality, value. Then you have low volatility. And then you have momentum. And then you have momentum, right? So in a smart beta strategy or a factor-based strategy, if anyone asks you in the market, in any kind of corporate interview also, right? There are four major factors or four major smart beta strategies. You have quality, you have value, you have the low volatility, and you have the momentum, right? Four major, very important, and we'll try to decode these one by one, okay? So if we talk about the quality strategy, so what basically happens in quality, we're trying to focus towards good quality companies. And what do I mean by good quality companies? The companies having good, strong fundamentals. For all of those who know how to do fundamental analysis, how to do valuations, how to read financial ratios, how to prepare financial modeling, right? All those guys are very well versed with the quality segment. So what are basically the good quality companies which have good profits, good free cash flows? Because again, I've been stressing in every video, every module, every live lecture, the free cash flows are the most important indicator for a company's performance, much better than the profits. It's important to know how much profits gets translated towards the free cash flows because not always all the profits gets translated towards free cash flows because the P&L also has a great component of the credit which is not the actual profit the company has made and which might not get converted into cash at a later point of time. But a free cash flow statement or a cash flow statement records the actual inflows and outflows of cash, what actual cash the company has what actual profits have been converted to cash. So focus towards the free cash flows of the company, the profits of the company, ROE, ROC, right? The return on capital employed and return on equity. Focus towards the debt to equity ratio. So basically companies having higher free cash flows, companies having higher profitability, company having a lower debt. Even if the debt is higher, that debt should be justified, right? The debt should be taken for more expansionary projects, for more diversification projects. The debt should be productive. It should increase the EPS of the firm. As we all know, the basic principle of the corporate finance, that till the point of time the cost of debt is less than cost of equity, till the point of time the cost of debt is less than cost of equity, taking more and more debt will always have a magnifying impact upon the EPS of the firm. मतलब जब तक cost of debt cost of equity से कम है and हम debt ज़्यादा ले रहे हैं, it will always boost your profits. But at a point of time, a point will come when your cost of debt is greater than the cost of equity. At that point of time, the profits of the company or the EPS being a proxy of the profits will start to decline, right? So debt is always a double-edged sword. We need to see the liquidity of the company in terms of the current ratio, the quick ratio, the efficiency ratios we need to see, right? The debtors turnover ratio, the creditors turnover ratio, fixed asset turnover ratios. All these things we need to see. The debtors conversion period, the creditors conversion period, inventory cycles. All these things are very important to analyze a good quality company, right? So all these are basically the characteristics or the determinants which you guys tend to use to assess a good quality company versus a bad quality company. So all these things you need to have to analyze, you need to understand what exactly differs or what exactly bifurcates between a good quality company or a bad quality company. Now, a quality company might not always be undervalued. The second principle, the second point, the second factor, or the second smart beta strategy, value, right? And what do we mean by value? I won't be stressing upon much time in this component because we've already learned about the financial modeling and valuation. So in value, we are trying to find out those companies which are undervalued, which are trading below their intrinsic value, right? So for example, what is intrinsic value? Now, intrinsic value is the most basic fundamental or the fair value of a company. We use financial modeling and valuation to calculate the intrinsic stock price. That is, basis all the fundamentals, basis all the cash flows, what share price the company should command. Company kitna price deserve karti hai, basis upon all the fundamentals, and that is the intrinsic price. So if the intrinsic price of a company, now how to calculate the intrinsic price is by the financial modeling exercise, right? For all of those who do not know, please learn about it. Watch my modules, watch my live lectures, right? Watch the YouTube videos, right? But the thing is, if the intrinsic value of a company comes out to be 100 and the company in the market is trading at 120, it means the company is overvalued, right? कि कंपनी डिजर्व तो करती है 100 रुपए का शेयर प्राइस, पर मार्केट में वो कंपनी बिक रही है 120 रुपीज में, राइट? महंगे पर बिक रही है. A point of time will come when 120 will come down to 100. Now, if the earnings are supporting that company, that 120 might not come down to 100. It might go up to 130, 140, 150. That's a different thing. I've talked about that component also, right, in my previous videos. But the thing is, the earning growth should justify, right? Even if the company is highly valued, sheerly overvalued, but the earnings growth is justified, even that higher valuation is also justified. You can even buy more of that stocks or have a neutral approach. That is neither buying nor selling. Correct? But if the intrinsic value is 100 and the stock market, the share is trading at 120, correct? The company is overvalued. But if in the market, the company is trading at 80 rupees, at 70 rupees, the company is undervalued because the fundamentals suggest that the company deserves a price of 100 rupees. पर मार्केट में तो वो तो बहुत चीप पे बिक रही है, बहुत सस्ते पे बिक रही है, 80 rupees or 70 rupees or 90 rupees. A time will come and this 80 will get translated towards 100 rupees, right? So that convergence between the actual share price, be it ज़्यादा वाला price या कम वाला price, and the intrinsic value will converge, right? Keeping all the other things in isolation, correct? So that is one thing. So in value strategy, we're trying to find out undervalued companies, cheaper stocks, but with good fundamentals. The penny stocks can also be cheap, right? But is it really good to buy a penny stock? No, because a penny stock has no fundamentals, no cash flows, no profits, higher debt. The companies go off the market. The companies go into bankruptcy. The default. People tend to file suit against those companies. Those are basically like pump and dump kind of stocks, right? So good quality companies in terms of value, because quality and value are interrelated, but they're separate also, correct? So undervalued companies being supported by good fundamentals. Now the thing is, not every quality company might be undervalued. Quality companies might be overvalued also, correct? We're trying to understand these measures separately. Just do not think that a quality company will always be undervalued. A quality company will always have low volatility. A quality company will always have high momentum. No, we're trying to understand these parameters, these smart betas or factor strategies separately, right? So a quality company might be undervalued, a quality company might be overvalued also. If it is undervalued, it's good to buy that stock or a specific company or a share of that company. But if it is overvalued, we need to understand why it is overvalued. If the earnings are not justifying the overvaluation of a quality company, then we can sell off that company, or we can have a hold strategy, a neutral strategy. But if the earnings are justified, the earnings growth rate, right? So whenever we say earnings growth rate, we are saying EPS growth rate, earnings per share. EPS is the proxy for profits. I've talked about these terminologies, these concepts deep dive in my previous videos also. So watch them. But if the EPS is justified, the growth rate is justified, the growth rate in earnings is justified, right? And a quality company is overvalued, but the growth rate in the earnings is justified, the higher growth rate in the EPS is justified, then why to sell off those stock? Have more, or again have a hold strategy, right? So we need to understand different parameters and different scenarios. It might not always be good to sell an overvalued stock if the earnings growth rate in EPS is justified, and vice versa. It might not always be good to buy an undervalued stock, because you won't buy a penny stock anytime, correct? That's the quality principle. It's a value principle. Third one is your low vol, the low volatility principle, the companies which are less risky. And how do we assess the risk of a company? A company is having a lower beta, a lower standard deviation, a low variance. The variance is a square of standard deviation being the under root of variance, right? So all these companies which have a lower standard deviation, lower variance, lower beta. Now, how to calculate standard deviation? What is variance? What is beta? I've talked about those in my previous modules. Won't be stressing much upon that as of now. तो वो भी एक बार देख लेना बीटा क्या होता है, टाइप्स ऑफ बीटा, सिस्टमैटिक रिस्क, अनसिस्टमैटिक रिस्क, हाउ टू कैलकुलेट स्टैंडर्ड डेविएशन, वेरिएंस, डिफरेंस. All these things have been talked about in detail. You won't find that content anywhere deep dive practical content, right? So companies having a lower standard deviation, a low variance, a low beta are the low volatility companies, less risky companies. Now, a quality company can also be a less risky company. It can be a high risky company. An undervalued company can also be a low vol or high vol. An overvalued company can also be a low vol or a high vol companies. So basically, if we talk about growth investing, जब हम growth investing की बात करते हैं, right? The growth is not, it's not a factor. There's always a debate. Or a kind of a discussion or argument between the growth style of investing and the value style of investing. The value is a separate kind of a beta strategy, but growth is somewhat which is different from these beta strategies, right? So usually we talk about the growth style of investing, in which we pick up those companies which have a higher potential for growth. If we pick up those companies which have a higher potential for growth. Now, which companies have a higher potential for growth? There might be some new age companies, some startup companies, right? There might be some IT companies. There might be some mid cap and small cap companies which have the potential to become either a mid cap or a large cap in future, right? Because these type of companies, they exhibit a larger growth rate as compared to large cap companies. The large cap companies might also exhibit it, but the rate of growth of the small cap and the mid cap companies will be far more higher as compared to large cap, because there's a higher potential that a small cap company might become a mid cap company, or a micro cap might become a small cap company, or a mid cap company might enter into a Nifty Next 50 or a Nifty 50 index, becoming a mega cap or a large cap company, right? And again, these companies tend to have a higher price to earning ratio. And why do they have a higher price to earning ratio? Because people have a positive sentiment about those companies. Those are high growth companies. The market prices in their higher growth potential, right? We usually talk about something called as PE re-rating. PE re-rating and PE de-rating. So if you are PE re-rating, that is the price to earning multiple of a company is rising, right? So for example, what happens if the current share price of a company is 100, right? And its earning is 10, right? So what's the price to earning of a company? The price to earning comes out to be 10, right? 100 by 10. Now, if the price rises from 100 rupees to 200 rupees, right? And the earnings per share comes out to be 15. In that case, the price to earning comes somewhere around 13.3, right? Let's try to understand. Earlier, the share price was 100 and the EPS of the company was 10, correct? EPS is a proxy for profit. अगर profit बढ़ेगा तो EPS भी बढ़ेगा. The simple formula for the price to earning we know already is the current share price divided by the EPS of a company. So 100 by 10 gives you 10 price to earning. So basically, for $1 worth of the earning of a firm, where we have want to pay or we are willing to pay 10 rupees or $10 per se, right? So just to maintain the consistency of currency. Similarly, if the price of that particular company only usi company if the price rises from 100 to 200 rupees and EPS also rises from 10 to 15, again we calculate the price to earning, simple logic, 200 by 15, 13.3. So for $1 worth of earnings, we are willing to pay 13.3 rupees. Correct? Now the thing is, पहले हम 10 रुपए दे रहे थे, अब हम 13.3 दे रहे हैं. But if we see the magnitude of increase in the share price versus the earnings, we can see the share price has risen by a higher percentage by the earnings, or like basically versus the earnings or vis-a-vis the earnings. The share price has risen by 100%. वो 100 से सीधा वो 200 पे हो गया, right? But the earnings have risen just by 15%. Share price from 100 to 200 into 2x, 100% rise. But the earnings just grew by 50% from 10 to 15. Correct? So what we can say, so the earning growth have risen by a lower quantum, but the price have risen by a higher percentage. Maybe the market prices that in. The market believes the stock price to grow in future or the company to grow in future. They believe the company is strong, or maybe the company has good fundamentals, or maybe has a company has a brighter future, high growth potential. If the company is able to deliver that 50% earnings, it might be able to deliver 60%, 70%, 80%, 90%, 200% in the near to medium term basis or a long term basis. Because that company might be a small cap company, it might be a mid cap company, it might be a startup company, it might be a tech company, IT company, AI company, growth oriented company, which has the potential. So the company might be seeing that, the analysts might be seeing that, right? The valuation experts might be seeing that, right? And they believe that the price agar बढ़ भी रहा है, it shall be justified by this earning growth in future. That's a PE re-rating. And PE de-rating is just the opposite. If the price is falling, earnings are falling, they will de-rate it. Correct? So that is the thing. So basically what happens in a growth strategy, just make a note of this point somewhere. In a growth strategy, approximately your 60% of the return for those stocks, अगर कोई stock A है, and that's a growth stock, for the sake of simplicity, if it's a stock A and it's a growth stock, a startup company, 60% of the earning, 60% of the rise in share price, 60% of the rise in share price shall be attributed towards a PE multiple derating. PE multiple re-rating, sorry, not derating. अगर कोई भी स्टार्टअप कंपनी है, ग्रोथ कंपनी है, the companies which follow growth style of investing, the majority of the return shall be attributed towards the PE re-rating. PE multiple को re-rate करने की वजह से, that is sentiment की वजह से, that 60% is being contributed towards the earnings of the firm or the growth of that firm. And the remaining 40% comes out of actual earnings and fundamentals. Whereas if we talk about value style of investing, it's the vice versa. In a value style of investing, 60%, approximately 60% or more, comes from the fundamentals, the EPS, the earning component in the denominator. And the remaining 40% comes from a PE re-rating. Because value companies, they might be high quality, not high quality, but strong mature companies, large cap companies, which might be trading below their intrinsic value. Those are not high growth companies always. You might find some ikka dukka high growth companies in the Nifty 50 also, right? But majorly are the small cap, mid cap, tech startups, AI companies, right? So always in a growth strategy, in growth stocks, majorly the earning component will come from a PE re-rating, 60%, and 40% will come from actual earnings and EPS. But in a value strategy, approximately 60% will come from earnings or fundamentals, and 40% shall come from PE re-rating. That's a difference we need to know, right? Then we talked about low vol. Now we have momentum. Again, momentum is simply based upon price. Momentum is simply based upon price. If the price of particular companies or sectors is rising, they have a higher momentum, right? And it's being done based upon 3 months past performance, 6 months past performance. If a 3 months past performance or a 6 months past performance indicate the stock price is continuously rising, it indicates a positive momentum. And the vice versa is also true for a negative momentum or a downward trajectory for that particular stock or sector. But here we need to know that when to use these strategies, because these strategies, we have different funds which use these strategies combined, but not all these strategies might work always. And why do the funds are using all these strategies combined? Because one strategy might work well in some time when the other strategy is not working, right? Because when you have a market environment, when a quality strategy will work, the other three strategies might not work. So a fund having a quality factor only, a quality ETF will do well in that particular cycle when the quality does well. But if you have some other cycle when the quality doesn't do well, the fund will suffer losses or the fund will go into the downward trajectory. Same with value, same with low vol, and same with momentum. So basically, when we talk about a bullish cycle, when everything is rising in the market, momentum strategy works the best. Because usually at that particular point of time, even a stock with poor fundamentals does well. We might be going towards a bubble because everything in the market is doing well. Because even if not a bubble, a high momentum fund or a high momentum ETF or a stock will do well because it's a bullish phase. When you have a bearish phase, when the market is not doing well, right? There is negative sentiment. The bears are heavier than the bulls. So in that case, what basically happens? The value factor tends to do well. Undervalued companies, low value companies, not low value, that sounds bad, but undervalued companies. Stocks having an intrinsic value which is much higher than the current share price, right? And when you have a recovery phase, you might be having a kind of a recession in the market, a depression, or a quite bearish phase. And from that particular point of time, the market starts to rebound. The market starts to grow a bit, goes towards consolidation, and then rises. In that phase, low volatility coupled with high quality can do really good. Because in that segment, we do not want high volatility because that's a phase of high volatility. Because from a bearish market, you're going towards consolidation, then rising, then again the market might come down for a short term, right? And then it might rise continuously. So that tends to be a highly volatile period. So in that particular scenarios, we basically want a low vol and a high quality. In the previous 2 to 3 years after COVID, right? The momentum was doing really good. The momentum segment did really good. Currently, after the recent correction, not a crash, after the recent correction that we have seen, many fund managers and many portfolio managers have started to pick up the high quality and the low vol companies. Though large cap has corrected, mid cap has corrected, small caps have corrected, they have come closer to the fair valuation or somewhat below, lesser than the fair valuation also. But they're not completely undervalued. It's very, very difficult to find super undervalued sectors as of now, right? But the thing is, in this market, a low vol, because the market has become too volatile in the previous 6 months, sometimes it goes down, it consolidates, it goes up and then comes down. We have global market events, tariffs, US dollar, interest rate, inflation, XYZ things are there. It's a very volatile environment, at least for the next 1 quarter. So in this scenario, the fund managers have started to shift their approach towards a high quality and a low vol portfolio. If you see historically, past 1 year ka return, right? Where momentum has given you the worst return, approximately minus 10%. Because the previous years, not years, months were not good for momentum. That translated towards a negative 1 year bad performance for this momentum, 10 to 12% गिर चुका है, right? The maximum return has been given to you by quality. That's a positive 6.4% or so, right? Even your, I would say, enhanced value, right? We have a different index, enhanced value. We have a low vol index also, right? Your low vol index again has given you around 4% odd. Your low vol index has given you a 4% or 4%. odd return. So that's the highest return in case of beta. But both enhanced value and quality have given you -6%. It's not +6%, it's -6%. So -10% for momentum, -6% approximately for both your quality and value, but +4% for low vol. Because the market in the past 6 months was highly volatile. And those fund managers who've had the low volatility stocks in the portfolio or followed a low vol smart beta strategy were able to give extra 4% alpha to their clients. But majorly mota, it's time for high quality and low vol. If we do not want companies having a higher standard deviation, higher variance, higher beta per se, the beta is questionable. But at least they should be high quality companies. Value is difficult to find, and momentum in this market is not good because it's a downward momentum now. Correct? So that is the thing, because past 6 months indicate a downward momentum. So low vol and high quality companies is a strategy as of now. Any questions? Anybody? Basically, these are smart beta strategies. And various funds combine all these four strategies together. Sometimes, somewhere you might find something as your equal weighted strategy. A fifth factor that comes into place is equal weighted. So equal weighted has also done very well for many mutual fund houses, be it DSP and others, right? But equal weighted may basically what they are doing. An equal weighted strategy, they're trying to provide equal weights, right, to all these things: quality, value, low vol, and momentum. So like one way is this. Or the second way is they provide equal weightage to all the stocks. So for example, if it's a Nifty 50 they want to track. So Nifty 50 में जो 50 stocks हैं, all the 50 stocks will get equal weightage and equal weighted ETF for a passive fund. Again, the drawback of this fund or a strategy is there might be some sectors or might be some stocks that might overperform or outperform the market. So the returns of that outperformance might not get translated towards these equal weighted funds. But again, these equal weighted funds play a safer buffer because they're assigning equal weight to every stock in a Nifty 50 if it follows a Nifty 50 or a Sensex 30 if it follows a Sensex 30. So जितने भी उसमें stocks है सबको equal weights दे दिए जाएंगे in the portfolio composition. That's an equal weighted strategy. Any questions as of now for the smart beta factor strategy, active passive? कुछ क्वेश्चन क्वालिटी पे है, वैल्यू पर है, लो वोलेटिलिटी पर है, मोमेंटम पे है, इक्वल वेटेड पे है. I would suggest everyone have started to invest in the markets. You might be having an app with you, be it Grow, be it Coin, be it Zerodha, be it Angel One. Go to the mutual fund investing. Type the smart beta strategies or smart beta funds. You'll get a list of funds. See their composition, see their tracking errors, see their stocks and weightages. It will really help you out in understanding these things practically. Any questions, anybody? Well, if someone wants to understand the market deep dive, is planning to build up a career into ETFs, into the world of ETFs and passive strategies. So again, smart beta is something that you need to know. It's very crucial. It's very important. Smart beta strategies. Any questions, anybody? Okay. So this was it for today. So thank you guys. Let's meet in the other session. Thank you so much.